Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 30 minutes here on Options Guide TV. We're going to get a little crazy, a little nutty. The markets are nutty. Why can't we be nutty is what I'm thinking here. We have the S&P 500 index down again today. We're down 40 points at this point in time, about 0.75%. The VIX index is hanging up about the 22 level. We were a day late and a dollar short placing our VIX trade. We talked about it on a Wednesday, and by Friday, the markets were already back up towards the 20% level. I think the VIX belongs where it is for now, and the 22 level is just about right. Now, the benefit of the VIX being at that level is that allows us to do some of our interesting trades or advanced trades in the S&P 500 index. We have the SPX at 5541 right now, and we're going to go out and review our trade that we put together on Friday. Now, we talked about the 5600 level and that was a big level that we were bouncing around that area, and if we could break below, we definitely wanted to do the trade, but we had it all set up. And so the market has definitely gone below the level, and we're at a point where you could take it off. So I want to talk about this, and then I want to talk about my thoughts on the SPX bear trade that we did on Friday. And then I want to combine a trade. We've been doing well recently with the bearish put butterflies and also the bearish skip strike call butterflies as an alternative to selling a short call spread. I always want to emphasize that because I'm not always sure who's showing up new on Options Guide TV. But we always think of skip strike butterflies as an alternative to a short spread more than an alternative to a butterfly. Okay, so yeah, let's go. Let's do it. Let's go to the Tradier Pro software. And in the software, we're showing, here's the markets at 5542. We're way deep in the money. Like I said, the stock was right around 5600 when we put this trade on. 5605, actually, I don't have the exact number, but doesn't necessarily matter. We put it on for $2.40. Well, let me look at it. Let me be more accurate. Yeah, $2.40 was the price that I had when I took the screenshot was $2.40. So for every 1x2x1 butterfly, we paid $240. That was our max risk. We opened up a wing on the downside. And because we opened that wing, if the market went down, we were happy about this trade. So now we're in a situation where do you close it and take it off, or do you actually watch it? Because it's hard to get hurt on this trade at this point in time. The maximum that I can trade for down here is $5. And I've seen it when I started the show, it was at 410 because that's where it was at right now. Now it's at 465. So you could toss something in there around 410 to 420. The maximum it could trade for is $5. We put it on for $2.40, $240. And I'll go to the what if calculator and kind of take a peek at that. So now this is basing it off of today's prices. So remember that. I can't really adjust it to make it reflect what we did on Friday. But with that said, market was up here, right in this range. If the market went down, our short spread in the butterfly is 10 points wide, and our call spread is 15 points wide. So that leaves $5. So that means that if the market goes below our lowest strike, the 5,580 strike, that this would trade for the difference between the spreads, which is $5. So if it's anywhere down here where it's at right now at expiration, this should be worth $5. We paid $2.40 for it. Now, here's where the beauty is in trading the S&P 500 index is that with the market down to that level, it's cash settled. There's no exchanging of stocks, especially not all 500 of the stocks in the S&P 500 index. Not quite 500, actually, a little less. But with that said, if the market does come down and it's trading below the lowest strike, you just end up with cash in your account. And if you did it for $2.40, you did make $2.60, and that will be reflected in your account. You don't have to do anything. If it's 1 cent in the money, the Options Clearing Corporation will exercise all your options, including the shorts ones. You'll be assigned on those option contracts. Now, so here lies in the decision. If the market does come back, we don't want it to come back today, but if it comes back tomorrow and starts heading back into the close on Wednesday, we can actually get more than the $5. And we can get quite a bit more. We could get on this entire trade, the maximum, I'll put my cursor right up here, that it would trade for is $15, which is the long call spread or put spread. I'm sorry, the long put spread. The width of that is $15. So if you were lucky enough that you would go out right at the pinnacle, right there, you could make $15. You could sell this for $15, subtract out to $2.40, and that's where you would be at on the trade. So do you want to risk it? You feeling lucky? Because that's really what it's about at this point in time. Do you want to give up? If you can sell this thing, I don't like that I want 410. I don't want to get, there we go. It's listening to me, it looks like. See, I saw 450, 460. Okay. So I would put something in maybe at 450 and let that ride today. And if you can get out for 450 on the trade, as a matter of fact, let's just put that number in there. I see it dance. If you get out for 450 on the trade, I'll take it. And then just have no more risk and not think about it. It's really how active you are. If you are around all day today, all day tomorrow, all day Wednesday, and you're actually watching and you're trading, I would hang around. And once again, if I had more than one on, if I had 3 on, I'd maybe close 2 and let 1 ride. That would be the way that I would approach this position right now, because you do got a chance. Even if it lands right in here, right in this area, you could sell it for a dollar or 2 more, and there's not a ton of risk. Your only risk is that it snaps back, flies through the strikes, and tomorrow morning it's above 5,600. That would be your biggest risk. If you're not, if it moves too fast against you, it will hurt, and that's all it will hurt. It will hurt because there's too much time premium in the 5590s, including the fact that volatility is also jumping today too. So that would hurt if we got back to this level. Okay. Any questions on it? Then, yeah, I already have a comment on it. Anthony says that he would definitely stay with it and watch it. All right, we'll leave that out there. I appreciate it. And I appreciate your candor, knowing that you're not in the trade. And yeah, I like this one on Friday. Mondays are crazy. I don't like to do the skip strikes as much on a Friday with a Monday open, right? Because the huge spike up can be detrimental to having the skip strike or any type of short type spread. So, but I do like the open wing butterflies where your risk is defined, and you put them on a Friday, and news happens over the weekend, and then you can take it off on Friday morning. So today, what I'm going to propose, and I've not set up a trade this way before, so this will be my first time on Options Guy TV doing this trade, and I haven't done this trade in my own account but I don't know if really had market conditions to do it, where you're having, I guess maybe during COVID, where you've had sustained volatility up above the 20% level. But COVID, after the initial spike down, the markets were up. They're not leaning as bearish as the field to the market is right now, just in general bearish. All right, let's look at it. I'm going to put the trade together. Let's do it. We're going to do the same expiration. I'm going to assume that you took this trade off, okay? Not saying that you would have, but I don't want to have both the positions on. So if I'm putting this new trade on, I'm going to take this off, try to get 450 for it, and that's where I would be. All right, so now let's go on this level. We'll go 15 points again on the downside, 55.35. Let's buy that. Let's go 15 points down to the 55.20. We'll sell 2 of those, and then we'll go down to 10, and this should be trading for under 250, I would think. 2 is close. Gosh, it's all over the place. Maybe 250. You definitely want to work this order. 260 is press. I see 250. I'm going to go 260. Okay. So on Friday, we put a trade on very similar to this based off of where the market was at. And we put that trade on for $2.40. The vol is up, obviously. And we have the weekend went away as far as time decay is concerned. So we're paying 20 cents more on a Monday with a similar type setup on the trade. 55.35. All right. I would actually even slide it down a little bit. I would go 5,500. Okay. I would probably do it right on that, but I'm not going to chase the market because by the time I move it down, then the market's going to move back up. But I would probably go about 5 points in the money. 55.34 is where the market's at. I would start this at 55.30. Okay. $2.60, I think, is a fair price based off of where it's flying on the midpoint. And now let's do a skip strike butterfly. Let's do both of them with this Wednesday expiration. Kind of like this thought. Never really thought about setting it all up this way, but let's look at this. 56.50 is 1 standard deviation. That's a 16 delta. This is 15 point. Let's go here. Okay, we'll buy this one. God, we could almost go 15 points wide. We'll sell 2 of these. Once again, I don't want to chase the market. So I'm going to set it up. I would consider a 15-point wide one as opposed to a 10-point, but I'm going to set it up 10 points. 15, 16. Okay, here's the 15. Let's buy, sell. That's 10 points. And then we'll go skip the 56.80 and buy the 56.90. 90-cent net credit to the account. It's not bad. 1 standard deviation move out of the money, and that's highlighted here inside the options grid by where the shading is at. The delta is also kind of telling us that. So it's really 16 delta is about where a 1 standard deviation move would be. You're 1542 here, getting it done for a net credit of 90 cents to the account. You're offsetting the 90.
Brian, there's some issue with your camera. I can't hear you and I can't see you.
All right. Now you can hear me, right?
Yeah, I hear you, but I can't see you.
It stopped the sharing. Okay. Thank you.
You're welcome.
I think we're back, right? Oh, and the camera's kind of weird.
Yeah, exactly.
All right, let's just ride with no camera.
Okay.
I'll stop the camera. And there we go. Okay, awesome. So in this instance, we have a 90-cent net credit. We put the butterfly on for $2 and $2.60. So if we got this done for $1, we would be looking at 160 plus the $1,000 of risk that we have on the upside, which is the short spread that we put on. So in this instance, here is our skip strike butterfly that we have on. Trading within that level. Here it is. Let me zoom in on it a little bit. The market is right here, 5,542. Our strike price is 5,660. That is where our risk would kick in. If we just did the call spread, our risk would kick in. Well, this actually isn't risky until we get to the skip strike, which is the 5680 to the 5690, which is just the short spread. So if I look at that, I'm just going to do real quick math, not put it all out. 5680 to 5690. God, that's looking like close to $1. So it's 580. It's like $1.10. So our butterfly is fairly cheap because we're still getting $1. So our butterfly is our hedge in this trade is probably 10 or 15 cents. And we can look at that if you would like, but that's probably about what we're paying for it. Let's remove this leg, 5690. And let's add this 5680. Yeah, look at that, 10 or 15 cents. That's a very cheap butterfly because it's only 10 points wide. So you're getting a hedge. You have 2 days to expiration. You're getting this done for 90 cents versus maybe $1.20 if you didn't skip the strike. And you have the same amount of risk as being in a short spread from 5680 to 5690. But if the market comes roaring back, it's still going to hurt us. If the market comes roaring back and hits us. But if it does it closer to the expiration date on that Wednesday, well, not too shabby. We would turn out, you could put this on for a net credit and take it off for a net credit. So here's the whole gamut of trades. Let me get rid of this leg. 5680, and we'll go back to the 5690. So you have $1,000 requirement if you put this on. If we can get this done for, I think 90 cents is accurate. Man, it's looking like maybe $1. I'll say it's $1. Just 90 cents is accurate. Let's be accurate. 90 cents, I think we could fill it at. And then so that's in the what if calculator. And then let me add the other trade. So here's that one. We're going to get rid of this one. Yeah, this is the one that is today that we put on Friday. And we'll add one more here. Get rid of this. And let's go down here. We got where was it? Do you guys know before I had my screen screwed up? 50. I would go here with the 5540. Let's just do it. Let's reset it this way. Okay, we'll buy this one. We'll go down 15 points to here, and we'll sell this twice, and then we'll go down 10 points and we'll buy that once. 260 is what I want to pay for it. All right, and then we'll send that to the what if calculator. Okay, so I would enter these as 2 trades and I would work the trades. Market is right here. Pull this a little bit tighter. And so on this trade, we don't mind if the market continues on down. If it goes up this way, we got $2.60 worth of risk, which we're taking another 90 cents off of that because we got a net credit from the other trade. There's no additional margin to put on this trade. And then here is our other butterfly. Remember, here's the market. Here's your pin. 55.50 right here. 55.50 right here. So this is the bear side of the trade, where we definitely want the market to go down. This trade is also bearish, but it's more neutral to bearish. The market drifts higher, we're okay if it drifts higher. If it gets to this strike right here, well, we want that to happen on Wednesday. We don't want that to happen tomorrow. But if it does move against us and we fell asleep and never got out of this trade, the maximum that we could lose on the trade would be 10 points or $1,000 per 1x2x1 butterfly, plus the $2.60 of the put butterfly that we put on. And that would be our max risk on the entire trade. And that only happens if the market closes above this strike and we don't get out of anything on the trade. Interesting alternative. So we'll watch this one. And like I said, I'm not going to put this on in this direction because I've never set one up like this. I don't think I've ever had market conditions where I felt like this made sense. I have looked at doing 2 skip strike butterflies as an alternative to an iron condor, and I've done a trade like that before, but I've never done one where we're going to lean bearish and then we're going to also have on the skip strike butterfly. So we want to watch the entire position. If you get all of the legs in the trade on, we can actually add that to the P&L calculator. As a matter of fact, I'll do that for next week's show. I'll get all I guess it would be all 6 legs of this position into the profit and loss calculator before the show starts. And that's what we'll look at doing. Do we have any other questions? We do not. Okay, interesting trade will be done on Wednesday. It's amazing that we can get these butterflies done for the prices that we are. And that is all because of the pumped up implied volatility. If you're doing a butterfly, you're selling 2 option contracts, and those option contracts really drive the strategy. If you're right on your forecast, you want implied volatility and time decay to go away on those short options because that's where you want the market to land. And until it does, it's hard to get paid the maximum on a butterfly. So if those vols are up, when you initially put on the trade, the butterflies will be cheaper. And that's what we're seeing here. So normally, if the VIX was down around 12, 13, we would probably look at, on a Monday trade, we'd look at a Friday expiration. Gives us a day to adjust the trade in that. But then you'd get a little bit more time premium, and that would bring the initial cost of the butterfly down. But vol has came up so much that it makes it feasible to look at these type of trades with the Wednesday expiration. It's not out of the picture to do it every once in a while with a Wednesday expiration, but the skip strike butterflies, the shorter the time premium, the better you have, because if this market turns against you really hard to begin with, the position will be will hurt you. It will not be profitable. All right. I think that's going to be it. Yeah, we're at time. I was going to talk a little bit about NVIDIA. Market's down. I'm going to look to do in my own account another cover call on steroids. We'll set that up maybe next week, but it looks like we have an April 17th expiration on our covered call with steroids and NVIDIA, and it's time to close that out and put on another position. You don't just, it's basically trading for next to nothing because NVIDIA is now all the way down to almost where it was after the split, right around $100, trading somewhere in that range. So I'm still bullish long-term on NVIDIA. Things just got to kind of shake out, but the fundamentals of the company, it's not like you're buying a stock that doesn't have any earnings, doesn't have any fundamentals. One point in time, it was the largest company in the marketplace. They're not going away, but the market is down. So I'm going to continue to do those type of cover call positions to try to hedge it. and try to get a little bit of a bounce back if the market starts coming back and taking advantage of it, which we've already done it once, and actually it paid out. Got an extra $700 on our 100 share because NVIDIA came all the way back and actually closed right where we wanted it to on expiration. Yeah, we did that on one of these trades. All right. Any other questions? I feel like I'm just rambling on. Let's get together on Wednesday at 11 a.m. Eastern time. Let's see what's going on with this SPX trade. It should be a fun one to watch. And we'll review it, and we'll look at another trade. Maybe we get bearish again in the SPX. This has worked out really well for us over the last 3 or 4 weeks. Thanks for stopping in, and we'll see you this Wednesday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.